There are moments when a government program looks like a retirement policy on the surface, but underneath it is really about something much bigger. It is about who gets access to capital markets. It is about how money flows into assets. It is about how government spending is financed. It is about inflation. And it is about the difference between people who understand the machine and people who only feel the consequences of the machine after it reaches their paycheck, their savings, and their cost of living. That is how I would look at the new Trump IRA idea described in the source. Most people will look at it and see only a retirement account. They will ask, is this good for me? They will ask, do I qualify? They will ask, how much free money can I get? Those are practical questions and they matter, but they are not the whole story. The deeper story is that the government is trying to create another channel that moves regular workers' money into the stock market, while also adding government contributions for certain lower-income workers. That means more access, it means lower fees, it means more buyers. It means more money flowing into financial assets, but it also means more government spending in a system that is already running deficits. And when a government is already spending more than it takes in, every new promise must be funded somehow. That is where the real analysis begins. So let us start with the basic problem. The 401k system was supposed to help American workers retire by giving them a tax-advantaged investment account connected to employment. A worker earns income. Some of that income can be contributed to the 401k. The money can be invested over decades. Taxes are deferred or structured differently depending on whether the account is traditional or Roth. In theory, the worker retires with a pool of assets. That is the concept. But the concept has not worked equally for everyone. Many high-income workers have access to employer-sponsored plans. Many professionals have companies that offer 401k matches. They receive automatic payroll deductions, employer contributions, and institutional investment menus. But millions of workers do not have that. Uber drivers, gig workers, small business employees, low-income workers, part-time workers, workers at companies that do not offer retirement plans, people who change jobs frequently. For them, the 401k system is not always the same wealth-building machine. If your employer does not offer a 401k, you cannot use that employer plan. If your employer offers a weak plan with high fees and poor investment options, you may still participate, but too much of your future return can be eaten by expenses. If you leave the job, rolling the plan over or moving it can be confusing, slow, or intimidating. If the minimum contribution feels too high, some workers never begin. These are not small flaws. They change who builds wealth. A retirement system that works well mainly for workers with stable employers, higher incomes, and good benefits will naturally favor those workers. That widens the gap between people inside the asset system and people outside it. The Trump IRA is described as an attempt to address that gap. The idea is to create an account not tied to a specific employer. If you work in the United States, you can access it. It is portable. It has no meaningful minimum because you may be able to start with as little as $5. The fees are capped at 0.15%. And for people under certain income limits, the government may contribute up to $1,000 per year through a 50% match if the worker contributes enough. On the surface, that is very attractive. Lower fees, more portability, broader access, a government match, a simpler starting point for a worker without a 401k. That can be meaningful, but every financial benefit has a source. There is no free money in a closed system. Someone pays. Sometimes the worker pays through fees. Sometimes the taxpayer pays through taxes. Sometimes future taxpayers pay through debt. Sometimes everyone pays through inflation. This is why the phrase free money must always be examined. Free money is often expensive because it is paid for through a channel people do not see immediately. That is one of the great lessons of government finance. Now, before we talk about how it is funded, we must understand the fee issue because fees are one of the quietest and most powerful forces in retirement. A fee looks small. 1% does not sound like much. 1.25% does not sound like it can change a life. But over decades, small annual fees compound against the investor. This is the mirror image of investment returns. Returns compound for you, fees compound against you. If you invest $500 per month for 30 years and earn an 8% return before fees, the account might grow to around $679,000 under the simplified math in the source. That sounds like a strong result. But if the average fee is around 1.26%, the ending balance may fall to about $540,000. The difference is around $139,000. That money did not disappear in one dramatic event. It leaked out year after year in the form of fees. This is why fees matter. They are not an irritation. They are a claim on your future compounding. If the fee instead is capped at 0.15% and the returns are otherwise similar, the ending balance in the example is around $660,000. The total fees over the working career may be about $19,000 instead of $139,000. That is a huge difference. The worker did not save more. The worker did not earn a higher market return. The worker simply lost less of the compounding machine to fees. This is a critical principle. If two funds or retirement structures provide similar exposure and similar returns, the lower fee structure can leave far more wealth in the hands of the investor. But fees are not the only variable. Sometimes higher fees are justified if the strategy, management, tax structure, or performance advantage is real. But most people do not know whether they are paying for value or simply paying because the system allows it. That is why every worker should know the expense ratio of the funds they own. Not just the name of the fund, not just the account balance, the fee. A person can work for decades and lose a large part of their retirement compounding without ever feeling the loss in one moment. That is what makes fees dangerous. They are quiet, they are legal, they are often disclosed, but many people do not understand their long-term effect. So if the Trump IRA truly caps fees around 0.15%, that feature is meaningful. It means more of the return may remain with the worker. It reduces one of the structural disadvantages that low income and less financially sophisticated workers often face. Now, the second problem is access. A 401k depends on the employer. If the employer offers it, you may participate. If the employer does not, you are outside that system that creates inequality in retirement access. People who already have better jobs often get better retirement benefits. People with weaker labor market positions often get less. That is how systems reinforce inequality. The Trump IRA is described as a government-linked account that follows the worker rather than the employer. That matters because the modern labor market is not the same as the old one. Workers change jobs more often. Gig work is more common. Contract work is more common. Small businesses may not offer retirement plans. A retirement account that travels with the worker may fit the modern economy better than a plan tied to one employer. Portability matters because friction destroys action. If people have to fill out forms, call old employers, roll over accounts, choose custodians, and understand tax rules, many will procrastinate. Then small balances sit in old plans, fees continue, accounts are forgotten, the system becomes fragmented. A portable account reduces some of that friction, and when friction falls, participation can rise. The third problem is minimums. A worker who can only invest $5 may think investing is not for them, but the habit matters. The first $5 will not create retirement, but it creates entry into the system. It creates identity, it begins the behavior. It teaches the worker that even small amounts can buy ownership. This is important because many people never start because the starting line feels too high. If the account says you need $50, $100, or a larger minimum, a struggling worker may wait. If the starting point is $5, the psychological barrier falls. That matters. A wealth-building system should make beginning easy. The hard part should be staying consistent, not opening the door. Now, the fourth feature is the government contribution. The source describes the potential for up to $1,000 annual government match for lower-income workers. To receive the full amount, the worker must meet income limits and contribute enough to qualify. The full match may require a worker to contribute $2,000 in the year, with the government contributing 50% up to $1,000. For a low-income worker, a $1,000 annual contribution can be meaningful. If someone invests $2,000 and receives $1,000 from the government, that is an immediate 50% boost before market returns. In ordinary investment markets, a guaranteed 50% match is extremely valuable. This is why employer matches are so powerful in 401k plans. The Trump IRA is attempting to give a similar benefit to people who do not receive an employer match. That is the social policy logic. But here is the macroeconomic logic. If millions of workers contribute to these accounts and the government adds matching dollars, those dollars will flow into the stock market or investment funds. That means new demand for financial assets. The estimated range described in the source is around $32 to $68 billion of new money entering the stock market. Those estimates should be treated carefully because the program is new and assumptions can change. But the direction is clear. If the program starts and participation grows, it creates incremental buyers. And asset prices are shaped by supply and demand. If more buyers enter the market, all else equal, prices can be supported. Not guaranteed, not every year, not without volatility, but structurally, a new retirement channel that directs money into equities can be supportive for the market. This is exactly how retirement systems have shaped markets before. 401k plans created a regular flow of money into funds. IRAs created another channel. Free brokerage platforms created more retail participation. Automatic contributions created steady demand. Index funds transformed how capital flows into the largest companies. Now, the Trump IRA, if implemented as described, could create another channel. This is how financial infrastructure changes markets. Not because of one dramatic day, because money flows repeatedly through a pipe. When a new pipe is built, investors should ask where the pipe sends money. If the pipe sends money into the stock market, then the stock market may receive a new source of demand. That does not mean stocks only go up. That is too simple. It means the long-term flow structure changes. Now we must talk about the cost. The United States government already spends more than it collects. The source describes a rough picture, around $5 trillion in tax revenue and around $7 trillion in spending, leaving a deficit of about $2 trillion. The exact numbers can change by year and projection, but the structure matters. A government running a large deficit is already borrowing to fund existing promises. If it adds a new promise, the gap grows. Unless something else changes, the government has only a few ways to finance that gap. It can raise taxes, it can cut spending elsewhere, it can borrow more, it can borrow from domestic investors. It can borrow from foreign investors, it can rely more heavily on the central bank system. If taxes are being cut rather than raised, and if spending is not reduced enough elsewhere, then additional programs generally increase borrowing. That is the core issue. Borrowing itself is not always bad. A government can borrow productively if the spending creates future growth that more than covers the cost. But borrowing to finance recurring transfers or programs in an already deficit system must be understood, honestly. The money must come from somewhere. If the government issues more debt, someone must buy that debt. Households can buy it, banks can buy it, pension funds can buy it, foreign countries can buy it, the Federal Reserve can buy it, directly or indirectly through monetary operations, depending on conditions and policy choices. When the Federal Reserve creates money to support government borrowing or financial markets, the money supply can expand. And when money supply expands faster than the supply of real goods and services, the purchasing power of the currency can fall. That is inflation. You can print dollars. You cannot print wealth. You can create bank reserves. You cannot create more houses, food, energy, factories, doctors, or productivity by keystroke alone. If the government prints or borrows excessively without matching real output, the result is often higher nominal asset prices and a weaker currency over time. This is why government programs that inject money into financial markets can have two opposite effects. They can help individuals build assets, and they can increase inflationary pressure if funded by debt and money creation. Both things can be true. This is the part many people miss. A policy can be good for asset owners and bad for wage earners who do not own assets. If more money flows into the stock market, investors can benefit. If that money is funded through more debt and monetary expansion, inflation can pressure ordinary savers and workers. So the same policy can widen the gap between people who own assets and people who only hold cash or rely entirely on wages. That is why understanding the system matters. You do not want to be the person who only receives the inflation side of the policy while missing the asset side. If the government creates programs that push more money into markets, a financially literate person asks, where is the money going, and how can I own part of the asset receiving the flow? That does not mean blindly buying. It means understanding the incentive structure. Now let us talk about the stock market opportunity. If the Trump IRA creates more access and matching contributions, the immediate beneficiary is not one single company. It is broad market ownership. Money may flow into diversified funds, index funds, and low-fee options. It may support total stock market funds, SP 500 funds, and other simple products. Funds such as VTI, which tracks the total U.S. stock market, and SPY, which tracks the SP 500, are examples of broad market vehicles. The point is not that those exact funds are right for every person. The point is that they represent the kind of assets that benefit when more retirement money flows into the stock market. A total market fund owns thousands of companies. An SP 500 fund owns roughly the 500 largest companies in the U.S. market. If the stock market rises broadly over time, those funds participate. If the stock market falls, they fall too. There is risk. There is no guarantee, but they are simple ways to own the system rather than trying to pick one winner. This matters because a new retirement pipe will likely direct much of the money into broad funds. That is how most retirement systems work. Regular contributions, diversified vehicles, low fees, long time horizons, automatic participation. Those flows can be powerful. They can also make the market more sensitive to liquidity and policy. When more money is automatically directed into markets, asset prices can become more supported on the upside, but volatility can still increase when confidence breaks. The source makes an important point. Free money and more access can raise volatility. That seems counterintuitive, but it makes sense when more retail money enters markets, when government incentives pull in new buyers, and when people who have not experienced full market cycles begin investing. Emotional flows can increase. More buyers can push prices higher. But when markets fall, inexperienced investors can also panic. That can create bigger swings. So this program does not eliminate crashes. It may even help create larger cycles, more money in, more enthusiasm, higher prices, then corrections, then panic, then opportunities for people with liquidity and discipline. That is how markets often work. Every inflow system creates opportunity, but also risk. The smart investor does not assume the market will only rise. The smart investor understands that more money flowing into markets can lift asset prices over time while also making the system more volatile. Volatility is not only danger for prepared investors. Volatility can create opportunity. Market crashes and recessions can create more millionaires than calm markets because they allow disciplined investors to buy good assets at lower prices. But that only works if the investor has cash discipline and emotional control. If the investor panics during the crash, they become the seller, not the buyer. This is why education matters more than access alone. Giving people accounts is not enough. Giving people matching money is not enough. If they do not understand fees, diversification, inflation, volatility, and long-term investing, they may still make poor decisions. A good retirement system needs both access and education. Access puts people in the game. Education helps them stay in the game. Now, let us examine the inflation issue more deeply. If the government gives $1,000 per year to qualifying workers, those workers may feel they are receiving free money at the household level. That may be true. The account gets more money. The worker owns more assets. That can be a good thing. But at the system level, if the government must borrow or print to fund it, the cost is spread through the currency. Inflation is not always an obvious tax, but it acts like one. It reduces the purchasing power of savings. It makes food, housing, energy, insurance, and services more expensive. It hurts people who hold cash. It hurts people whose wages lag prices. It helps borrowers in some circumstances because debts are repaid in cheaper dollars. It helps asset owners because asset prices often rise in nominal terms. This is one of the most important realities in modern finance. Inflation transfers wealth from people who hold currency to people who own scarce or productive assets. That is why participating in the asset system matters. If you only save dollars in a bank account while the currency loses purchasing power, you can feel safe and still become poorer in real terms. If you own productive assets, you at least have a chance of keeping up with or exceeding inflation over time. That is the logic behind investing. The Trump IRA, by pushing more people into ownership, may help some workers get on the asset side of the inflation equation. But if the program is funded by more debt and money creation, it may also contribute to the inflation that makes ownership more necessary. This is the paradox. The policy may help solve the problem, it also worsens. That is why thinking in systems is so important. Now, many people will focus only on the political identity of the program. They will say it is good because they like Trump or bad because they dislike Trump. That is not how serious investors should think. Serious investors study incentives, flows, balance sheets, and second-order consequences. The question is not whether the name appeals to you. The question is what the account does. Does it increase access? Does it lower fees? Does it create matching contributions? Does it direct money into equities? Does it increase government spending? Does it require more borrowing? Does it support asset prices? Does it add inflationary pressure? Who benefits? Who pays? Where does the money flow? Those are the questions. The answers may include both good and bad elements. That is normal. Most policies are trade-offs. A policy can expand retirement access and still create fiscal pressure. A policy can help low-income workers invest and still increase debt. A policy can support the stock market and still hurt purchasing power through inflation. The world is rarely one-dimensional. Now let us think about how a worker should approach this if they qualify. If the government offers a 50% match up to $1,000, that is difficult to ignore. If you contribute $2,000 and receive $1,000, the immediate match is powerful. But you should still understand the rules, income limits, contribution requirements, withdrawal rules, tax treatment, investment options, fees, penalties, portability, account structure. You do not want to blindly enter any account without understanding how it works. But if the program works as described and you qualify, the match may be one of the best opportunities available to build wealth. The first step is to capture the free match, if the rules and your personal finances allow it. The second step is to keep fees low. The third step is to choose diversified investments appropriate for long-term retirement. The fourth step is to keep contributing even when the market falls. The fifth step is to avoid treating the account like a short-term trading vehicle. A retirement account is not supposed to be entertainment. It is supposed to be a compounding machine. That is the mentality. Now, if you do not qualify for the government match because your income is too high, the lesson is still useful. Fees still matter. Broad market exposure still matters. Tax advantaged accounts still matter. Portability still matters. Government spending still affects inflation. New flows into the stock market still affect asset prices. So even if you cannot receive the match, you should understand the implications. A new flow of money into equities can support market demand. Inflationary funding can support nominal asset prices while hurting cash. Volatility can increase. Corrections can create buying opportunities. This is how the financially savvy think. They do not only ask, what can I receive? They ask, how does this change the environment I am investing in? That is a more powerful question. Now, let us examine the 401k more carefully. A traditional 401k allows pre-tax contributions. You put money in before taxes. It grows tax deferred. And then you pay taxes when you withdraw in retirement. A Roth 401k uses after-tax contributions. You pay taxes now. The money grows, and qualified withdrawals can be tax-free later. Both are powerful because they allow money to grow inside a protected tax structure. The problem is access and quality. Some plans have good low-cost index funds. Some plans have expensive mutual funds. Some plans have poor menus. Some plans have administrative fees. Some plans are easy to use. Others are confusing. A worker may not know whether their plan is good or bad. This is why fee awareness is essential. If your 401k has a low-cost SP 500 fund at 0.03%, it may be excellent. If it has mostly funds at 1.5% and administrative costs, you need to understand the drag. Not all 401ks are bad, not all are expensive, but averages hide differences. You must look at your actual plan, do not assume. Now, the portability issue is also real. When people change jobs, they may leave old 401ks behind, they may forget them, they may not roll them over, they may pay fees in multiple places, they may lose track of investment choices. A portable account reduces that problem. In a modern economy where many workers change jobs repeatedly, portability can be a major benefit. This is one reason employer-tied retirement systems can become outdated. The labor market changed. The retirement system did not fully adapt. The Trump IRA, at least as described, is an attempt to adapt the retirement vehicle to a more flexible and fragmented labor market. That is the practical appeal. Now let us look at the market effect again. When money flows into broad stock funds, it often flows disproportionately into the largest companies, because market cap weighted funds allocate more dollars to larger companies. This can reinforce large company dominance. If more retirement money goes into SP 500 funds, the largest companies receive the largest share of the inflows. That can support mega-cap valuations. It can also make indexes more concentrated. This is already a feature of the modern market. Indexing has many benefits: low fees, diversification, simplicity, but it also creates a flow-based system where money enters the market according to index weights. If a new retirement account channels billions into broad indexes, the biggest companies may receive a large portion of that demand that matters for investors. A broad index fund is not neutral in the sense of equal ownership. It is weighted toward the largest companies. So when you own the index, you are also making a bet that the largest companies continue to justify their weight. That may be reasonable, but it should be understood. Now, suppose the program contributes $32 to $68 billion into the stock market over time. In the context of the entire U.S. market, that is not enormous. The U.S. stock market is worth many trillions, but flows do not need to be the only force to matter. They can add to existing forces: 401k flows, IRA flows, buybacks, index fund flows, foreign capital pension allocations, retail brokerage flows. If the Trump IRA becomes another recurring pipe, its long-term significance may be larger than the first-year estimate. The most important market forces are often recurring. A one-time flow is interesting. A repeated flow becomes structural. That is why retirement accounts matter. They bring money in regularly, every paycheck, every year, across millions of workers that can support markets over long periods. Now, the government contribution itself may also create political feedback. Once people receive a benefit, it becomes hard to remove. If workers become used to a yearly government match, future politicians may hesitate to cut it. The program may expand. Income limits may change, contribution amounts may change, investment options may change, political incentives may grow. That is how government programs often evolve. They begin with one structure and then become larger or more complex over time. Investors must watch not only the initial design, but the future political path. A small program can become a larger flow, a low match can become a higher match, a limited account can become a broader asset pipeline. That is not a prediction, it is a possibility to monitor. Now let us think about who benefits directly. Workers without 401k access may benefit from easier retirement saving. Low-income workers who can contribute enough may benefit from government matching low. Fee fund providers may benefit if they become part of the program. Index funds and broad market ETFs may benefit from new demand. Brokerage platforms or custodians involved in administration may benefit. The stock market may benefit from incremental flows. Asset owners may benefit if inflation and flows lift nominal prices. Who may be hurt? Cash holders may be hurt if the program contributes to inflation through debt and money creation. Taxpayers may eventually pay if the program is funded through future taxes or interest costs. Bond markets may be affected if more debt issuance is required. Workers who receive the match but do not understand volatility may be hurt emotionally if markets fall and they panic sell. High-fee managers may lose if low-fee accounts put pressure on expensive plans. These are the trade-offs. Now, how should a household respond? First, understand your existing retirement options. Do you have a 401k? Does it have a match? What are the fees? What funds are available? Do you have access to an IRA or Roth IRA? Do you qualify for tax advantages? Would the Trump IRA offer a match you do not currently receive? Second, understand fees. Look at expense ratios. Look at administrative fees. Look at whether you are paying for active management that actually delivers value. Third, capture matches if possible. Employer match, government match if available. Do not ignore free matching dollars, but understand where they come from. Fourth, invest in diversified low-cost assets. Broad market exposure is often a simple starting point. Fifth, prepare for volatility. Retirement investing is long-term. The market will fall at some point. Do not treat normal volatility as failure. Sixth, understand inflation. If the government is funding programs with debt and monetary expansion, asset ownership becomes more important. Not less. Seventh, keep cash for emergencies, but do not hold all wealth in cash if inflation is eroding purchasing power. That is the household framework. Now, if I were explaining this in the simplest possible way, I would say this. The Trump IRA may help more people enter the investing system, but the government does not create wealth by naming an account. Wealth comes from productive assets, saving, investing, time, and discipline. The account is a vehicle, the match is an incentive, the fee cap is a structural advantage, the portability is a design improvement, but the outcome still depends on whether the worker contributes, invests wisely, keeps fees low, stays invested, and does not panic. No account can replace behavior. That is the same principle across all investing. A Roth IRA does not make you rich by itself. A 401k does not make you rich by itself. A Trump IRA would not make you rich by itself. The vehicle matters, but the behavior inside the vehicle matters more. Now, let us examine the phrase, the government is printing money and injecting it into the stock market. That is a dramatic phrase. The actual mechanics may be more indirect depending on how the program is funded. The government can borrow, spend, and issue debt. The Federal Reserve may or may not directly monetize that debt depending on policy and market conditions, but the broader point is valid in system terms. If the government runs deficits and funds new contributions through additional borrowing, and if the monetary system accommodates that borrowing, then new dollars can support demand for financial assets while increasing inflationary pressure. This is the key mechanism. Government deficits can become private sector income. If that income is directed into investments, financial assets can rise. If the money supply expands faster than real output, prices can rise. This is why fiscal and monetary policy matter for investors. They shape liquidity. Liquidity shapes asset prices. Asset prices shape wealth distribution. Those who own assets benefit more than those who only hold wages and cash. This is one of the big forces behind wealth inequality. When policy supports asset prices, asset owners get richer. When inflation rises, cash savers and wage earners feel poorer. A retirement program that brings more low-income workers into asset ownership could help reduce that gap for participants. But if the same program increases inflation, non-participants or people unable to save may still be hurt. Again, both sides can be true. Now, what about the stock market itself? A structurally supported market can still crash. That is essential to understand. More retirement flows do not eliminate business cycles. They do not eliminate recessions. They do not eliminate valuations becoming too high. They do not eliminate credit crises. They do not eliminate geopolitical shocks. They do not eliminate panic. Markets will still fall. The difference is that recurring flows may create a long-term tailwind. A tailwind helps, but it does not prevent storms. This is why the best investor combines participation with preparedness. Own assets. Keep liquidity, understand volatility. Do not use money you need next month to buy volatile investments. Stay diversified. Buy good assets when fear creates discounts. Use crashes rather than fear them. That is the discipline. Now, the source's final point is that ordinary people need to understand the system so they are not harmed by it. That is right. If the system is moving money into assets and you own no assets, you may be left behind. If the system is funded through inflation and you hold only cash, you may lose purchasing power. If the system rewards low fees and you pay high fees, your compounding is reduced. If the system gives matches and you do not contribute enough to get them, you leave money behind. If the system creates volatility and you panic sell, you transfer wealth to more disciplined buyers. That is how people get hurt. Not because they are bad people, because they do not understand the machine. Financial education is not optional in a world where policy, markets, and inflation are so connected. The old belief that a worker could simply earn a wage, save cash, and be fine is less reliable in a debt-driven, inflation-prone system. Workers need ownership. They need low-cost investments. They need tax awareness. They need to understand government deficits. They need to understand how asset prices are supported. They need to understand fees. They need to understand that free money has a cost somewhere. That is the real lesson of the Trump IRA. It is not only a new account, it is a signal that the government recognizes many workers are outside the asset system, a signal that low fees matter, a signal that portability matters, a signal that the stock market remains the chosen retirement engine, a signal that government policy may continue pushing more money into financial assets, a signal that inflation risk remains part of the cost. Now, if you are an investor, you should not respond with anger or excitement alone. Respond with analysis. If you qualify, study the account. If you can capture a match, consider doing so. If you already have a 401k, review your fees. If you invest in funds, check expense ratios. If you hold cash, understand inflation risk. If you own broad market funds, understand that new flows may support them but not protect them from crashes. If markets fall, remember that recurring retirement flows and long-term demand can make downturns opportunities for disciplined investors. If you are outside the market, think carefully about whether that is wise in a system designed to push money into assets. This is how to think like an investor. You look at the policy, you identify the flow, you identify who benefits, you identify who pays, you identify the second-order effects, then you position yourself prudently. Now let us bring the full structure together. The 401k system has three major weaknesses in the source: high fees, limited access, and lack of portability. The Trump IRA is presented as a response: broader worker access, lower fees, portability, low minimums, and government matching for qualifying lower-income workers. The fee cap matters because a 1.26% fee can consume enormous wealth over 30 years, while a 0.15% fee may leave far more money in the account. The government match matters because a 50% contribution up to $1,000 can meaningfully accelerate retirement savings for people who qualify. But the funding matters because the government is already running large deficits. If the money comes through more borrowing and eventual money creation, it can add inflationary pressure. Inflation hurts cash holders and wage earners while lifting nominal asset prices. The new account may direct billions of dollars into the stock market, creating more demand for broad equity funds. That demand can support asset prices but does not eliminate crashes. In fact, more access and more free money can increase volatility. Volatility creates risk for the unprepared and opportunity for disciplined investors, so the right response is not to worship the program or reject it blindly. The right response is to understand it, use the benefits if they apply, protect yourself from the costs. Own productive assets, keep fees low, stay diversified, do not panic during volatility, and always remember that government money is never truly free. It is paid by someone somewhere through taxes, debt, inflation, or reduced purchasing power. If you understand that you can operate inside the system instead of being operated on by it, that is the purpose of financial education. Not to complain about the machine, to understand it well enough to make better decisions. The Trump IRA may or may not become exactly what the source describes. The details can change, the political path can change, implementation can change, but the principles will remain. Access matters, fees matter, portability matters. Government matches matter, deficits matter, inflation matters, flows into assets matter. And the people who understand where money is moving will usually have an advantage over the people who only react after prices have already moved. That is how I would think about it. Not emotionally, not politically, systematically. Follow the money, follow the incentives, follow the costs, then act with discipline.